Today is Sunday, December 20th, 2020. I'm your host, Max Gottlich, and I talk about my interpretations of financial markets and the overall economy. Now, right off the bat, you may notice the Max Gottlich show, which has officially, I guess you could say, launched on YouTube today. However, you'll also notice my poorly edited graphic of myself to the side. So if any of you are somehow miraculously a graphic designer, please message me and please help me. So the bubble mania across virtually all asset classes continues to prevail with, of course, Tesla and more recently Bitcoin taking the lead. Right. So Tesla shares year to date is up around 700%. Bitcoin is up 200% year to date, and the S&P is only up 50% year to date. But of course, these absurd surges in valuations is only a result of the absurdly biased sentiment based on the sole fact that interest rates are at historical lows. Uh, like mortgage rates, and especially even lumber prices have reached a new all-time high. And I think, they're going to go up. I think they are up 30% just this month alone, if I'm not mistaken. But although it makes sense because there have been an obvious trend correction to the upside for commodities within the past 2 weeks. So gold and silver and many other precious metals are breaking out from falling wedge patterns. And I believe we see new all-time highs in these metals going into the new year, even though the new year is just days away. And of course, the one thing that continues to weaken is the US dollar due to the Fed monetizing the debt and artificially suppressing the interest rates. And speaking of a debasing dollar, the net shorts are back huge. They're back really huge. In fact, the net shorts in the dollar index futures are actually up over 115% since March 2011. That is huge. It's definitely not, looking too hot for the deflation bugs as reality is slowly kicking in. And as a result, a Fed devaluation in the dollar, makes the small guys suffer. And you see, because already we're seeing small businesses raising prices, and this is no secret to anybody. Because if you take an improper measurement for inflation, like most commonly the CPI and the PPI, you'll know the government claims we're standing at around 2%, and they want even more. Uh, but if you take just 5 minutes of your time to create your own basket of goods that is not included in the CPI, like things people buy in their everyday lives, you'll see we're not at 2% inflation, but we're actually at 10% inflation. And why is that? Well, because more money is being pumped into the system by the magical printing press in perpetuity. Another ratio I like to look at, especially now given, it just surpassed 1929 levels, only by a margin, but it still passed 1929 levels in the S&P 500 CAPE ratio, and it stands for the cyclically adjusted PE for the S&P. And so it essentially uses real EPS, which, it just means that it means inflation adjusted earnings from the previous 10 years in this case. And as long as people perceive interest rates to remain low and go even lower, with the Fed bailing out all the components of a traditional free market economy, then asset price inflation will continue. Obviously, as we've mentioned in previous videos, there is literally trillions of dollars that will mature within the year. So when the Fed is forced to unwind their treasuries, yes, they will buy more, but this is the same structure as a Ponzi scheme. And eventually there will be too much to handle, literally, because, through the euro dollar system, the Fed has created a huge snowball of collateral backed by more phony versions of debt collateral. And so it's a complete sham. And this is why other currencies are, they're rising against the dollar, like, especially the euro, and the yen. Uh, so, in the euro and the yen, they're rising a lot against the dollar. And it's also a result of the $10 trillion injected in liquidity by the central banks very, very shortly after the March lows, literally just weeks after. And Powell's mission was always to promote confidence, that the Fed has everything under control and will not limit themselves on how much or what to buy. And I say that, I say what, because in March 23rd, and that was a pretty major date, because there was a major announcement there, corporate credit facilities were open. And liquidity rapidly came back, just as it went down when corporate bonds were just smashed to the ground, right in March. So all these government-backed programs and delusional acts of monetary policy, not just in the US, but around the globe, has ultimately enabled an increasingly humongous negative yielding debt market. And the disparity between unemployment and asset prices is also delusional because the stock market indicates confidence, uh, is it's even higher than that of the dot-com bubble, where obviously unemployment was nowhere near to as high as it is today. And I think the trend in unemployment really only goes higher from here, because when people realize the Fed doesn't actually have any money, businesses will be forced to cut costs. And like we saw very clearly in March, that cost saving strategy is cutting jobs. It wouldn't be as serious a problem, but it is, because the government has made it extremely expensive to hire people through all these ridiculous taxes. Also, because of excessive money printing and stimulus, you may notice our current account, which, that's just, a sovereign's imports and exports of, goods and services. And that's been free falling. And it's not only the Fed that owns US treasuries, it's also the large tech companies, like all the FANG stocks pretty much, but they have a combined value of treasury holdings of almost $250 billion, a quarter of $1 trillion. So what happens when they need to rewind also? It's important to keep in mind that in secondary markets, especially, there will always be a trade-off between the marginal buyers and sellers. And once you are a buyer, you will become a seller. Time is just the ultimate uncertainty to determine your returns. And as issuances on the long end of the curve, they continue. It basically continues, uh, to expose speculators to additional interest rate and liquidity risks. And duration is approaching almost 7 years, which is extremely high. I mean, we haven't seen duration like this since maybe 20 years ago. So clearly we are in a reflationary environment. I don't think anybody would disagree with that. But Congress has yet again to pass a stimulus bill. So all we can do is just sit here and dwindle with our thumbs until they do. I also wanted to discuss quadruple witching as it relates to Tesla being included in the S&P, uh, which was huge news, really, really big news. And first of all, quadruple witching, and we have triple witching, double witching. It's when index futures, index options, stock options, and last but not least, single stock futures, they all expire simultaneously. So it's called quadruple witching because these four asset classes I just told you, they expire on the third Friday of the month of, of every quarter. So obviously December is one of those months. And of course, because of the offsetting of already existing futures and options contracts that are profitable, there is a ton of trading volume, generally speaking. So they settle automatically with offsetting trades, so arbitrage opportunities certainly coexist. So traders can simply roll the contracts forward with their existing trade, and then they could book new contracts to be settled, sometime in the future. So when Tesla was officially included in the S&P this past Friday, as investors believe that Friday was pretty much the last day to make major portfolio shifts before 2020 comes to an end, that kind of liquidity trap. And apparently something like $80 billion was rushed out because of Tesla alone. And so speculators rushed into even more single stock calls. And I believe the number of option contracts expired that day on Friday was, like 100 million or 90 million, which is up 25% from last year. So whether it's 100 million, 90 million, it's more or less up 25% from last year. And this makes sense because the CBOE put to call ratio stands at its lowest level since the internet bubble, as we've talked about in depth in previous videos. Right. So basically, investors have never, ever been more bullish on stocks and, well, quite literally everything else. So again, we will see when stimulus arrives, and we'll see more money printing, which means we'll see speculators buying into a false pretense of hope like they have since the March lows. So this is all I wanted to cover today, and I really hope you enjoyed watching. Please make sure to hit the subscribe button and like the video. It'll help more people see my content more, that's for sure. And also, please note, I am not a financial advisor, and everything I say is for educational purposes only. Okay, thank you, everyone, and happy holidays.